A structured product is a made-to-measure investment solution. It combines classic financial products and at least one derivative product. This combination of products will enable investors to optimize the level of risk that they are willing to take, depending on the desired return. A very common type of structured product involves combining a bond and an option. Bonds are designed to help protect capital, while options allow investors to enjoy a potentially high return. This combination of products will enable investors to adjust the level of risk that they're willing to take, depending on the desired return. Let's look at an example. Oliver is an investor. He's looking for a made-to-measure product which meets his specific needs. After discussing this with his private banker, he decides to invest in a structured product. To help him decide, he must first know which risks he's prepared to take and what his desired return is. He decides to choose a structured product which protects 90% of his capital. He chooses a structured product issued by Bank X, which includes a Euro Stoxx 50 call option with a maturity of 2 years. This means that in 2 years, Oliver will receive at least 90% of the capital he invested, regardless of how the option develops. Note that the repayment will only be made if the issue is solvent. If Bank X goes bankrupt, then Oliver could lose more than his guaranteed capital. Oliver will also receive a payment if the Euro Stoxx 50 increases and depending on its growth. His product allows him to receive a part of the rise in the index while protecting against declines. This creates an asymmetric risk profile and is one of the advantages of a structured product. Oliver has chosen a product with partial capital protection. But if he had had other objectives, he could have chosen a product offering 100% capital protection at maturity. The risks are lower, but the return is also lower. He could also have chosen a product without capital protection to receive a higher return, but with no capital protection at maturity. Here, we have talked about fairly standard structured products, but this type of product may extend to all types of assets with an array of different characteristics. Investment in structured products are not risk-free. As already mentioned, there is of course the issue's credit risk, which will affect all types of structured products. And then there is a liquidity risk. These products are generally not listed publicly on a market. If you would like to sell the product early, you must accept the terms and conditions which are not always optimal, for example, a penalty fee. Lastly, there are risks which are intrinsically linked to the structure setup: currency risks, interest rate risks, equity risks, etc. While there are still lots of other things to learn about this form of investment, you now know a little more about structured products. If you would like to know more or would like to get started, we are here to help.